As we know, 2020 was a historic year due to the election, the pandemic, and other related challenges. Uncertainty never breeds confidence, and beginning in March, uncertainty was the key word. COVID-19 contributed to a rapid and dramatic decline in bank M&A, resulting in a more than 50% decline in deal activity from 2019. Bank stock prices declined significantly, which sidelined many active acquirers that suddenly found their acquisition currency at a suboptimal price. Additionally, between Paycheck Protection Program lending, taking care of their associates, and meeting the needs of their local communities, bankers' attentions were rightfully pointed elsewhere. I'm Rick Childs, a partner at Crowe LLP. I'll spend the next few minutes providing my perspective on the 2021 Bank M&A Survey. Crowe partnered with Bank Director to develop this research, which explored a unique environment. The survey was completed by bank directors and senior executives in the fall of 2020 and examined their acquisition plans for 2021. At that time, only 36% believed their institution would purchase a bank by the end of this year, representing a significant decline compared to our prior surveys. Bankers continue to look for the same attributes in an acquisition, though 2020 brought some areas into sharper focus. The majority of respondents told us that a complementary culture, an attractive deposit base, and efficiency gains ranked highest on their acquisition wish list. Deposits may seem a little counterintuitive, with so many banks experiencing a significant influx of deposits in 2020. But bankers know that these gains are likely to be temporary. In fact, deposits at many banks are returning to pre-pandemic levels. Over the last 3 or 4 years, bankers have had to fight to attract and retain deposits. An acquisition which could enhance the level and mix of deposits will provide long-term value to the buyer. Cultural compatibility can make or break a deal. It's a well-worn topic over the years, but many acquirers struggle with getting culture right. If the fit isn't there, it will not be cured post-transaction, and it threatens to dilute the focus on integration and successful completion of a deal. At face value, culture is a squishy topic that seems to elude accurate measurement. However, cultural surveys, management assessments, and open dialogue sessions can help banks convert this qualitative topic into a more measurable outcome. Don't overlook any warning signs that come up along the way. Culture isn't something you can put a Band-Aid on and hope for the best. Additionally, acquirers should be open to learning from their new colleagues. Developing a robust communication plan can help alleviate the uncertainty that a deal can bring. In our prior surveys with Bank Director, potential acquirers have well eclipsed potential sellers. Even this year, only 7% wished they had sold their institution before the pandemic-induced economic downturn. Lower stock prices for many acquirers has inhibited deals, but this has also opened the door for smaller community banks that can use cash as the consideration. With deal prices lower, some previously overpriced deals are now attainable for those same acquirers. Sellers' pricing expectations have posed a barrier to deal making year after year. In this year's survey, less than half believe they could easily sell their bank at a price the board would consider. It can be difficult for buyers and sellers to bridge this gap. You can't really cause a bank to sell, so acquirers should take the long view and keep in contact with possible merger candidates. 2020 wasn't the year for many banks, and 2021 may not be either. Focus on the changes you can make to your own bank and continue to be available in case something changes at a bank you wish to acquire. In our survey, more than half expected a slow economic rebound, and another 28% didn't expect the U.S. to return to pre-crisis levels this year. The pandemic promises to become more controlled later in the year, given expected broad acceptability of the vaccine. Specific to the industry, banks can expect profitability constraints from continued low interest rates and a likely increase in corporate taxes. The best term one could use for this year's expectations is muddied. 2020 was the second lowest year in terms of whole bank acquisitions in 30 years. Prices started to improve in the latter half of 2020, and it's likely that 2021 will be better in terms of overall volume. But I don't expect activity to approach normal ranges, which are around 250 deals. Visit bankdirector.com for the complete results of the 2021 Bank M&A Survey, and we look forward to your participation in next year's survey this coming fall.